Take a look at the revenues of a listed company over the last 11 years. This company's revenues grew from 5 crore in 2014 to around 1300 crores in FY24, a massive 75% annual growth. Now you would think that this company would make an exciting investment, but wait. A look at its stock price may give you second thoughts about investing in it. The stock has crashed by a massive 74% or 3/4 of its value 1 year ago. But why would a company with such strong growth suffer such a fate? More importantly, what's this company I'm talking about? Well, the company I'm talking about is Mishtann Foods, an agro-product company involved in the production, processing and trading of rice, wheat, dals and salt. A SEBI investigation in 2024 found that the company had been manipulating its revenues. Mishtann engaged in circular trading with fictitious buyers and suppliers, many of whom were shell entities controlled by the company's directors and associates. In other words, the company's revenues weren't real. They didn't originate from growth or high demand for the company's products. So, if you had invested in Mishtann looking at its fantastic revenue growth, you would have been in for a nasty surprise. Now, this suggests that in stock investing, checking the frontline numbers like revenues and profits isn't enough. You must go beyond those numbers to ensure they are not fabricated. But how can one do so? That's what we will discuss in this video. Hello and welcome to ET Money's YouTube channel. In this video, we will discuss how companies can cook their books and how you can spot it. If you are a stock investor with a portfolio, you can use the insights in this video to evaluate how clean the companies in your portfolio are. And if you're looking to invest in stocks, you can combine the insights in this video with your stock picking framework to make it more robust. Now, this video belongs to our playlist on how to pick stocks. To watch similar videos, you can explore it. The link is in the description. Okay, let's first talk about the challenges involved in finding out if a company is cooking its books. When we say cooking the books, the implication is that the company is doing something illegal, something that's violative of prescribed rules, possibly a fraud. But the reality is more complicated. The so-called cooking the books is the extreme end of the spectrum. A company can show its performance to be better than what it is while staying within the boundaries of prescribed rules and regulations. Now, that's possible through creative accounting or financial window dressing. And in many cases, it is not illegal. It's just financial jugglery where numbers are moved within the financial statements so that the performance becomes optically better. It's also possible that this creative accounting or financial window dressing is not intentional but just a byproduct of reporting standards. Now, whatever it may be, the challenge for you as a stock investor is to spot it at the research stage. But mind you, that's not simple. If there is indeed a manipulation of numbers, it would be done behind the scenes and in such a way that the vast majority of investors can't detect it. And that's why most financial manipulations go unnoticed for a long time until a company undergoes some sort of forensic auditing or investigation by a regulatory body such as SEBI. Now, we saw this in the cases of Yes Bank, DHFL, IL&FS, and more recently Gensol Engineering, a solar EPC company. The Gensol saga is still unraveling as we are recording this. A SEBI investigation has discovered that Gensol's promoters have diverted 262 crore of the company's loan funds for personal use. They used this money to purchase a luxury apartment and an ultra-expensive golf set. They also invested part of the cash in a startup and transferred some amounts to their mother and spouses. They even used some of it to trade in Gensol's shares. Now, SEBI also found that the company has made incorrect disclosures regarding certain orders. Now, since the news of fraud at Gensol broke, its shares have been trending downwards, down 86% from their level just a year ago. The promoter's other well-known company, BlueSmart, which runs an all-electric cab service in many Indian cities, has also stalled its operations. Most of the BlueSmart's electric fleet was owned by Gensol, which leased them to BlueSmart. Now, the investors in Gensol Engineering have already suffered massive wealth destruction, and with the stock hitting lower circuits every day, there appears to be no immediate respite. The point here is that such a financial manipulation is known only in hindsight, and the damage is quick and irreversible. Investors who relied on financial numbers and data reported by the company have difficulty accepting that the numbers themselves were forged. But this doesn't mean that you can't do anything at all. There are certain red flags or warning signs that can tell you that all is not well. Once you've identified companies that exhibit these red flags or warning signs, you can then dig deeper to ascertain whether the company is indeed doing something suspicious or if it is normal business occurrences or industry phenomena. Now, if you don't get a satisfactory answer, or if you're not sure, or if you want no trouble, you can simply decide to stay away from the stock and focus on the ones that come out clean. Now, we've discussed the theoretical aspect of how companies cook their books in 2 of our earlier videos. In this video, while we will touch upon how companies can cook their books or window dress their numbers, the focus will be on the application aspect. We will now see measures that you should incorporate into your research framework to unravel the red flags or the warning signs of financial manipulation. I will also give you examples of stocks within the BSE 500 to illustrate my point. But do note that just because a stock appears on the list doesn't automatically mean it's a shady company. Consider a company's failure to clear a particular measure a warning sign that you should look deeper into it before investing in its stock. But yes, if a particular stock flashes multiple red flags or a specific red flag in greater intensity, you can also simply avoid it to keep things simple. Okay, so let's begin with the first red flag or warning sign that should get you thinking. Revenue growth is often a good sign. Companies that show high revenue growth often see their stock prices go up. But too high growth should make you suspicious, as it may indicate financial manipulation, as we saw in the case of Mishtann Foods. Now, a high growth revenue number means that there is a tremendous demand for the company's product or service, and there has to be a good reason for that. If there isn't one, the growth may be fake. Now, some of the ways in which revenues can be inflated include stretching the accounting period to record higher sales, recognizing revenues that should be spread over multiple months or years in just one accounting period, recording revenues before the buyer's acceptance, channel stuffing, that is shipping out a product to the distributor before time, shipping out a wrong product and reversing the transaction in the next accounting period, considering the proceeds of a loan as revenue. Now you can check our earlier video on how companies cook their books to understand these points in detail. The link is in the description. Okay, let's now examine the BSE 500 group of stocks to identify those that have been delivering ultra high revenue growth of say 50% year on year for the last 4 quarters. Now 5 companies appear in this list: Distant Technologies, Eternal, formerly called Zomato, Index Wind, Suntech Realty and Tejas Networks. But let me restate that just because these companies have very high revenue growth numbers does not automatically mean they're doing something wrong. The point is that such growth is unusual and extraordinary, and hence it warrants extra scrutiny. Now, another related red flag is when a company has high profit growth but considerably lower revenue growth. Such a situation may suggest that the company's profit may not be originating from its revenues but from cost cutting or financial wizardry. Now, in the BSE 500, 8 companies have a 3-year revenue growth of under 8% but profit growth of over 20% per annum. Now, it's likely that this discrepancy between revenue and profit growth is due to exceptional item or tax write-backs. Yet such a discrepancy should alert you. Okay, let's now move to the next red flag. Like revenues, companies can manipulate their net profit in a number of ways. These include not recording an expense, pushing expenses for later to boost income, using one-time events creatively, shifting non-operating gains to the operating income and operating losses to non-operating income, shifting losses to discontinued operations. Now, we discussed this in detail in our earlier video. The link is in the description. Now, one effective way to check if a company's profits are real is to check if they've been backed by cash flows. That is, the company received actual cash for the profits on its books. Profits without the cash flows have a high chance of being fabricated. But why would the profits deviate from cash flows? Well, accurate accounting allows companies to book a profit before the actual cash realization has happened. So, the profit you see in the income statement is not necessarily cash received from customers. It may just be an accounting entry. Hence, you should always compare profits with cash flows from operations or CFO. Now, while a company can manipulate its accounting profit, manipulating cash flows is very difficult. That makes cash flows a better tool to check profitability than net profits. Now, that's the reason why sophisticated investors consider the price to CFO ratio as a better valuation metric than the price to earnings or the PE ratio. Now, normally, CFO would be greater than net profit as depreciation is added back while calculating CFO. So, a CFO to net profit ratio of 100% or more is healthy. Ratios of 80% or above can be considered good enough too. Okay, let's check non-BFSI companies in the BSE 500 whose CFO to net income has been under 50% for the last 3 years. All these companies are profitable at the PAT level, but given their low CFO to PAT ratios, their profits may not be as good or reliable as they appear. In fact, many of the CFO to net profit numbers are negative because the CFO values are negative. Now, this implies that while the company showed a profit, there was a net cash outflow from the operations. This should be a bright red flag for investors. But one caveat here. Sometimes the business model or the sector in which a company operates has a bearing on the cash flows. For instance, construction, real estate, and infra companies can report negative CFOs owing to the nature of their work. Yet negative CFOs for multiple years shouldn't go unnoticed. Now, on similar lines, if a company has been reporting rising profit but its cash flows are falling, that can be a negative sign too. Finally, in place of CFO to net profit, some analysts suggest using CFO to EBITDA. Now, CFO to EBITDA helps evaluate how much of operating profit is converted into cash. So, it measures cash generation from a company's core operations. Like CFO to net profit, the higher the CFO to EBITDA ratio, the better. Now, this brings us to the next red flag. One way of posting high revenues is to record sales without getting the corresponding payments from customers. These due payments from customers are recorded in the balance sheets as accounts receivable. Now, if a company's accounts receivables have grown at a faster rate than its sales, it may be a warning sign as it shows that the company is aggressively booking sales without getting the corresponding payments. Okay, let's check which non-BFSI companies in the BSE 500 have a widest gap between 3-year growth in accounts receivable versus 3-year sales growth. The minimum sales growth should be 20% per annum. The topper in this list is Swan Energy, whose accounts receivables have grown by 306% per annum against sales growth of 150% per annum. Next comes TBO Tech with a gap of 88 percentage points. And after that, there is Aegis Logistics at 54 percentage points. Now, these 10 companies have handsome sales growth numbers over the last 3 years, but their receivables have grown even faster. Of course, the size of sales and receivables is important too, and you should consider it. For instance, while Avenue Supermarts also appears in the list of top 10 companies with the widest gap between sales and receivables growth, its accounts receivables for FY24 are just 0.33% of sales. On the other hand, in the case of Swan Energy, the FY24 receivables are 38% of sales. So, the situation is rather serious for Swan than for Avenue. Now, this brings us to the next warning sign. But before that, if you're finding this video useful and would like to watch more such videos, do subscribe to our channel and don't forget to press the bell icon so you never miss a video from us. The profit and loss statement or P&L has a number of line items. These include revenues, cost of goods sold, selling, general and administrative or SG&A expenses, operating profit, other income, interest expense, depreciation, tax outgo, profit after tax, minority interest, and profit or loss from discontinued operations. So, there is an ample scope for companies to play with numbers across these to make specific metrics look more appealing. For instance, by cutting SG&A expenses and moving them elsewhere, a company can boost its operating profit. Normally, as sales rise, so should SG&A expenses. But quite a few companies in BSE 500 have registered sales growth while reducing their SG&A expenses. There are as many as 10 companies whose revenue growth has risen by at least 12% over the last 3 years, but their SG&A expenses has fallen by 12% or more. Of course, this can signal rising efficiency as well, but is also counterintuitive. Similarly, a fall in depreciation outgo can improve profitability. But a fall in depreciation amid a rise in capex should be seen with suspicion. Now, 8 companies in the BSE 500 reported a decline in depreciation by at least 10% year on year in FY24, while spending at least 10% more year on year on capex a year ago. Yet, another factor that can improve profitability is capitalization of expenses. Now, capitalization of expenses means shifting a particular expense item to the balance sheet as an asset and expensing it over a period of time rather than in the current accounting period. The logic behind capitalizing an expense item is that it will continue to benefit the company for a longer period of time, so its cost should be spread over a period rather than expensing it in the current period completely. Of course, it is not a fraudulent practice, but it can surely push costs to a further date, thus boosting profits. Now, there are 7 companies in BSE 500 which have capitalized expenses in each of the last 3 years. Of course, the amounts involved matter too. If the amounts are too small, capitalizing them won't make a difference to the profitability. Finally, it makes sense not to stop reading the P&L at the PAT level, but to go further down to income or loss from discontinued operations too. Now, discontinued operations are those business activities or divisions that are no longer operational and have been shut down, and the income or loss arising from them is reported in this line item. A major loss from discontinued operations should be specifically paid attention to, and the PAT should be seen accordingly. For instance, in FY24, 2 companies stand out with respect to their loss from their discontinued operations: Aditya Birla Real Estate and Zee Entertainment. The losses from their discontinued operations were 80% and 29% of their FY24 PAT. Now, apart from the points discussed so far, there can be many other warning signs that can hint at the potential cooking of books. Let's take a quick look at them. First, if the company's auditor firm is frequently changed, or if the auditor leaves on its own accord, that could indicate there is problem with the company's reported financials. If the company's CFO and other top management officials leave the company, that could indicate something going wrong with the company. Second, if the company's auditor has flagged certain parts of a company's results or financials, the number should be seen in that light. Third, if the promoter has been selling his stake amid a booming stock price, the euphoria about the company's prospect may be misplaced. Fourth, if a company is involved in significant related party transactions, that should make you cautious, as they can be used to massage the financial numbers. Now, related parties are entities that are somehow connected with a company. They include a company's subsidiaries, other businesses of the promoter, family members of the company's directors, and key managers, etc. Fifth, companies that have a complicated corporate structure or those that frequently indulge in mergers and acquisitions can have more avenues to manipulate their numbers. Sixth, if the company says that it has changed its revenue recognition policy or the way it calculates depreciation, that can alter its revenues and profits overnight. So be cautious of such events. Seventh, inclusion of one-time gains in the operating section of the P&L can artificially inflate or deflate profits. Look at such items if there is a significant change in the operating performance. Eighth, if a company's management or promoter has a checkered past and a company associated with them has come under scrutiny, it may be sensible to steer clear of all group companies. Ninth, exercise caution when companies that show a profit just before their IPO. Such a profit may be transient and may be due to financial craftiness to make the IPO sail through. 10th, a company can pull a rabbit out of a hat by changing its business model. Keep an eye on such announcements. And with this, we have come to the end of this video. I hope the points discussed in this video will make your research framework more sturdy and help you stay away from potential blow-ups. And if you found this video useful, do share it with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.